Hello, welcome to Market Avenue. My name is Edward Nyako. Inflationary pressures have been building up across the globe, and to contain it, central banks across the world have been hiking interest rates. And the central bank in Ghana, as the Bank of Ghana, did same a couple of days ago. Today, we're going to look at how this hiking of the policy rate and how it's going to impact on price stabilization in Ghana. We're going to do that with Mr. Philip Abredu Otu, who is the Director of Research at the Bank of Ghana. Before we continue, let's pick the base language for today, and then Sadni Abdurrahman is standing by to give us a snapshot of the performance of the equity market for today. Hello, welcome back. Now we're going to the stock market with Sani Abdurrahman to tell us what happened on the Accra Bust for this midweek's trade.
Well, the session ended recording the biggest in terms of value since the start of the week. Activity was exciting on the markets. We've seen some exchanges across 12 counters as at the end of the session, and that has resulted into a value of 2.7 million Ghana cedis, the biggest since the start of the week. The composite index has also gone up slightly, appreciating by 3.16 points, and that gives a return of negative 1.68%. It means if you are invested on the market since the start of the year, your return is in the negative, but we are gradually seeing that the gap is being breached. For those who have invested in the financial stocks also, DS have gone up by 1.05% in terms of the return, because the index has gone up by 5.73 points, and that's because one of the equities that made the moves on the market today is in the financial sector, and I'll be telling you that soon. And that's Access Bank. It's appreciated by 19 pesos, sold 1,000 shares, and that has contributed to you seeing the financial stocks index going up. The biggest mover on the market today was New Gold ETF. It sold 16,488 shares and appreciated by 46.04%, and that has carried the market today, giving some excitement to investors on the Accra Best. So, Edward, if you ask me, largely that's what transpired on the market today.
But you know, going tomorrow, the Minister of Finance will be having a press conference.
Yes, of course. The Minister is suspected. You know, there was a 3-day retreat. Cabinet met to discuss ways to address the challenges facing the Ghanaian economy. And we are learning that government wants to inject an estimated $2 billion into the economy, and that will help address the issue of forex that we are seeing, the depreciating of the cedi, which has resulted in many confusion and complaints in the economy. We are also learning that government appointees will see a 30% cut in their salaries. The Council of State yesterday said they want to cut their allowances by 20%. There is a directive that the state agencies should also see a cut of 30% in their budgetary allocation. All these, I think, are austerity measures that government is adopting to ensure that there is some fiscal space as we have issues with our debt situation. So we are waiting to see more such measures that the minister will outline tomorrow and how it will impact the Ghanaian economy.
Fantastic. So we're waiting anxiously for tomorrow. But we'll go for a short break. When we come back, we're going to talk to the Director of Research at the Bank of Ghana, Mr. Philip Abredu Otu, as to why the Bank of Ghana has hiked the policy rate to 17%. Hello, welcome back to Market Avenue. Mr. Brady, you're welcome.
Thank you very much.
Great to have you in the studio.
Good to see you.
Great to see you again. Now, we've seen a trend across the globe. Central banks increasing their interest rate. Why this trend?
Well, I think if you look globally, there's inflation everywhere. In advanced economies in the US, in the United States, in emerging market economies, inflation is generally rising everywhere. But that has come about because of the measures that were taken at the time of the COVID. I'll go back to the COVID because all these things we are seeing started with the onset of the COVID and the measures that governments took to address the COVID. So in advanced economies, what we saw was massive fiscal stimulus and quantitative easing measures. And when we talk about fiscal stimulus, to keep it down, we are just talking about the cash injections that government put into the economy. In the US, they put it in to support businesses. They put it in to support big companies that were affected. And then they also, on top of that, they also pursued quantitative easing programs. And quantitative easing programs is basically when the central bank government goes in to buy back bonds that are held by investors. So by buying back the bonds, government is taking the bonds back from economic agents and then pushing cash into the system.
Wow.
So this is what happened. Massive injection of liquidity into the economy. And what advanced economies are facing today is basically the after effects of that liquidity injection. In the United States alone, for example, the liquidity injection was close to 20% of GDP.
Wow. That's a lot.
Yeah, that's a lot.
Trillions of dollars.
Trillions of dollars. And when you do that, this is the consequence. So we've seen inflation rise from near zero to almost 7.8, is heading to 8%. And what are they doing? They are reacting to the inflation that has come about, and they are using the tools at their disposal, which is the interest rate tool, to try to contain aggregate demand. So basically what they are trying to do is to raise interest rates, drain a little bit of the liquidity out of the economy, and then allow aggregate demand pressures to come down, and that over time will tame down prices in the economy. Wow. And again, when prices begin to come down, we then see a recoil back of the interest rates to where they were. Wow. So it's a simple strategy.
Interesting. So on our part of the world, if you look at frontier markets and emerging market like ours, if hikes are being done in terms of interest rates, what will be the effect on us?
Well, when you talk about frontier and emerging market economies, it depends on the characteristics of the economy in question. So you could have a frontier or an emerging market economy with weak fundamentals. You could have one with very strong fundamentals. When your fundamentals are strong, it acts like a buffer.
Wow.
And when these shocks come in,
you're able to withstand.
You're able to withstand. And then again, we have emerging and frontier market economies that have access to international capital markets. And we have emerging and frontier market economies that don't have access to international markets. The question is, where do we lie as a country? Ghana is a low-income country with access to international capital markets, and therefore we are frontier. That is where we belong. So we have access to international capital markets. We've borrowed resources from the international markets. They are interested in our economy because they've pumped resources into the economy, and they need to know how we are managing our economy because we need to pay them back in the end. So when these things are happening and we begin to see interest rates abroad go up, the investors are left with a choice. Which of these two countries are giving me a better return on the investment? Do I leave these frontier economies and go back to a safe haven country like the United States? So these are the choices that these countries, the investors are left with when interest rates begin to rise abroad. Now, so when a decision is made to leave a frontier economy like ours, it has implications. The central bank will need to provide dollars to ensure they leave safely. It impacts on our reserves. It impacts on the exchange rate. Inflation results. Central banks begin to react. Interest rates go up to contain these pressures. Growth also suffers in the end. So this is where we are. I think Ghana, we fall within this category, and rising interest rate abroad affects us significantly. We are already integrated in the world economy. We trade with Ukraine. We trade with Russia. The statistics are there. And therefore, when things happen out there, we are impacted. We are not left out. I mean, if you look at inflation, the story about inflation is the rise in inflation that we've seen has come about from a variety of factors. We've seen domestic, we've seen external, we've even seen domestic administratively price adjustment in petroleum prices, which is coming from crude oil. We've also seen climatic factors. Climatic factors have impacted on food significantly in the past year.
Yeah. Even our cocoa.
So there's a lot going on.
So we've seen the Bank of Ghana also following suit by going up 250 basis points.
Yes.
Now we're doing 17% policy rate.
Yes.
Why is the Bank of Ghana doing this?
Well, you just heard me. I just talked about what happened in advanced economies with the massive stimulus that they poured into the economy. We did same here in Ghana. You recall, at the height of the pandemic, the central bank provided 10 billion Ghana cedis in an asset purchase program. We also had a rapid credit facility of about $1 billion, which was around 5.345 billion Ghana cedis. And then lately we've also had the SDR from the IMF also coming, which is also close to $1 billion, which is also about 5.7, 5.9 billion Ghana cedis. I mean, these are massive liquidity injections into the economy. So when the IMF makes these advances to countries like us, the central bank takes over the dollars, but the central bank then pumps the cedi equivalent to government for its expenditures. It pours out into the economy. It's liquidity injection straight away. So if you look at it from the asset purchase program to all these resources that have flowed into the economy, we have also had our fair share of liquidity injection into the economy.
Yeah.
And we are beginning to see the effects on inflation. And this is where we are.
So we know that if there's a price hike, like there's a hike in policy rates like this, people who are into importation of goods into the country, food items and other things, are likely to go to the bank and borrow at a very high cost.
Yeah.
How does this affect pricing in the market?
Well, in the short term, there will be an impact. There will be an impact on the cost of borrowing. Those who use the banks to borrow for their operational activities will be impacted. Interest rates will go up, and they will likely pass on these interest rates to consumers. So there are short-term effects and long-term effects. The problem is we need to act to contain the inflationary impact. You know, inflation is a thief.
Yes.
It's a thief. It steals quietly from your pocket. It steals quietly from businesses.
Yeah, because if you go to the pump, like the fuel station, they were doing 6.9. Now they are now talking about 9.6, 9.5. So inflation is indirectly taken away from us.
I get worried about the rate of increase in the prices at the pump, and it's worrying. So for us at the central bank, we need to move to contain inflation. When we are able to contain inflation and inflation comes down, we will then begin to recoil the interest rates hikes that were put in to address inflation. So importers should not be too worried. The way I see this, it's a short-term measure that is being put to address a problem. And over time, when inflation begins to come down, we will ease.
Someone will ask, when?
Well, you know, these things take time to work through the economy.
Okay.
They take time to work through the economy. It depends. Every country has the way these policy measures act through the economy. Some it takes a quarter, some 2 quarters. For us, between 4 to 8 months, we should begin to see an impact on prices. But the central bank has done something this time around. What the central bank did was to use price and quantity to address the inflation problem. The price is the interest rate hike that we saw. The quantity measures, which are measured in macroprudential policies, are the decisions that we took to claw back the regulatory reliefs that we gave to the banks.
That is the CAR, the capital adequacy ratio.
The capital adequacy ratio.
Okay.
There's a conservation buffer. At the height of the pandemic, we just lowered it to give back to the banks. Again, it's the same liquidity problem, to give them liquidity to be able to extend credit to the rest of the economy. We lowered also the cash reserve ratio to give them some free money to be able to extend that to the rest of the economy. We are taking all those things back because
some are saying
because we are taking that back because there's a build-up of excess liquidity
in the system
and at the commercial banks level, and we need to claw that back quickly before they begin to translate into an endemic inflation. We don't want that.
But some say that yes, the central bank released all these things to the banks, but it didn't find its way to the targeted people that were meant to benefit from these reliefs.
So then maybe there's a justification to claw back. You have the answer. There's a justification to claw back.
That's interesting.
Yeah.
Great. So major issue now is the CD. How is this hike in policy rate going to help in the long run or in the short term to make sure that the pressure on the CD is eased?
Well, you know, the interest rate tool is a powerful tool. Prior to the hike, real rates were beginning to move into negative territories. And when real rates in an economy begin to move into negative territories, economic agents begin to look around and they are making decisions. They are making choices. What type of asset can I hold? Is it profitable to hold a Ghana asset or to hold a foreign asset? So these choices are being made. When they see that it's more lucrative to hold a foreign asset, they go for the foreign asset. They put pressure on the foreign assets. The demand goes up. The price shoots up.
So and you shift from CD-denominated assets to the greenback,
there's
the dollar.
A shift, yes.
Okay.
Yes. And basically that is what we have seen on top of other factors, and that is what is driving the exchange rate into these unwanted territories. Nobody wants that. And that is why we took the decision to correct that negative real interest rate that we had seen. We took that decision to also try to contain excess liquidity that is sitting out there to prevent those idle funds from finding their way elsewhere into other assets. So these were the main underlying reasons why we did what we did.
So how soon are we going to see that CD regaining some of its losses?
Well, we'll need to wait a while, and then the markets will have to pick up all these sentiments. Today, I think there was some little stability in the markets. I was monitoring the markets. I see some stability. But again, I think if you believe in what is known as policy mix, okay, there's always a monetary dimension and there's a fiscal dimension.
Okay.
The monetary has moved.
The fiscal,
the fiscal is moving tomorrow. I just heard the gentleman who opened your program saying that we are all waiting for the finance minister tomorrow. But that's the fiscal side. So monetary is working, fiscal is working. The two will need to work in concert to deliver a certain output in the economy.
Wow.
And that's what we're waiting for. So I'm confident.
Yes,
I'm confident. And I think the governor also said something at his press statement that I would want to re-echo. And
is it gold?
Well, no, he said he thinks that the worst is over.
Okay.
In terms of the exchange rate depreciation. The governor emphatically said that
the speculators cannot win.
They cannot win. He said the rates had overshot their long-term trend, and anything that overshoots its long-term trend comes down.
Now, if I'm a Ghanaian and I'm into business, we know certain that once policy rate goes up, we know certain that the private sector will be crowded out. What is being done to balance, ensure there's a balance? I can still do my business, perhaps engage some people, so the economy will expand.
So I talked about short term and long term. And again, I want to bring in the governor here. He also made a similar comment and said, there are trade-offs. There are trade-offs. So what we're facing now are trade-offs. There'll be a little bit of suffering. Interest rates will go up. The private sector will be crowded out, but it will be short-lived. So within the short term, let's deal with the problem. And when things begin to resolve, and we begin to see interest rates come down, we will then begin to ease on interest rates. So it's a trade-off. Growth will be impacted. There's no two ways about that. But we think it will be short-lived, and we'll bounce back up again.
So looking at the statement made by the governor, he talked about the gold aspect as well. How is that also going to help in
the gold?
The gold, yes.
Yeah.
In this regard.
What was?
He was talking about the fact that you have some gold. You buying some gold, and then they will ensure that the refining is done outside, so that they can use that also to, serve as a buffer to the city.
Well, so it's a good program, and the whole idea is to buy gold domestically to shore our reserves and to act as a buffer, so that in times like these, we can use the gold reserves to defend the currency. It's a very good and laudable program, but it will take quite some time, because to be able to convert your Doré gold into a monetary gold, you need to go through processes, and the gold will have to be refined, and it will have to be London Bullion Market certified. That process, we need to walk through that maze before we get there.
Wow. So overall, if I'm a businessman,
so basically, you just cannot pick gold and buy gold, and you sell gold, and you think that, well, now that I have gold in my vault, I can classify that gold as part of my reserves. You don't do that. You don't do that. You need to go through a process. So there's a refinery coming up, which is good news. I think it's a very big, bold first step. We are all excited about it, and I think over time they'll be able to deliver on their goals.
Wow.
Yeah.
A young man is in business watching us. Sentiment, business sentiment, confidence. How will all these measures translate into making sure that the sentiments for business people are not down?
So if you read our statement, sentiments are down. consumer sentiment is down, and then businesses are even more down than consumers. Why are sentiments down? They see all that is going on. They see what is happening to crude oil prices. They see rising prices of inflation in the markets. They see the difficulties around. They see that interest rates is going to go up because they know that inflation is going up. And they think these are all, in the short term, going to weigh down on their businesses. When we spoke with businesses, they were worried about what was coming. Mm-hmm. They were worried about what was coming. And these agents are making their calculations. They do make their calculations. They knew that interest rates was going to go up. They did not know the extent to which it was going to go up. So, you know, and all these factors. And then, again, if you look at what has happened to inflation now, issues associated with the Ukraine Russia geopolitical tension has not even started feeding into the numbers yet.
Wow. That's interesting.
Yeah. I mean, the war just started.
Just started, yeah.
It just started. And
it's building up.
It's building up. And the supply chain fears. Ghana imports fertilizer, wheat from Ukraine. All these
iron and steel.
Yes, I mean the prices here have changed significantly. A ton of steel has moved from 4,000 a ton to 6,000 a ton. That is significant. Yeah. So the building industry is going to be impacted. So the businesses, they know and they see the hardship coming. Business confidence has gone down. Consumer confidence has gone down, but that is why we need to act quickly to bring back confidence. When the agents see that an action is being taken to address a problem, they know. They know. So with time, they will begin to recalculate and revise their notes. Confidence will begin to build up. They will begin to get back into production. They will begin to plow back their profits back into business, and then we are all up.
Business is also, likely hinged on predictability and planning. So with all these measures, how is it going to help, if I'm a businessman, to help me to plan and predict or push my project going forward? So
the planning is always contingent on inflation. If you have a very stable and sound environment where everything is stable, even if you have inflation at 15 and it's stable throughout, there is certainty with that 15.
Yeah.
It's better.
Yeah.
And I think that is what we are trying to do. Create that stable atmosphere for businesses to continue to plan and then carry on with their businesses.
I'm sure the businessman out there, I want you to address that businessman in a second or two and tell him what you think as a Director of Research of Bank of Ghana you are seeing by the close of the year.
Well, so these are short, turbulent times. Everything is being done to contain the situation. The Bank of Ghana is ready to defend its inflation mandate. Fiscal and monetary policies are working together in concert to deliver stability. So to the businessman out there, be rest assured, it's a short-term blip. The crisis will be over very soon. Thank you very much.
Thank you, Mr. Philip Abedu.
Thank you very much
for your time. We've been talking to the Director of Research at the Bank of Ghana in the person of Mr. Philip Abedu Otu about the policy rate hike and how it's feeding into pricing on the market. This is how we wrap up on Market Avenue today. My name is Edward Nyako. God willing, we'll come here tomorrow. Remember, the Minister of Finance will address the nation tomorrow about the fiscal side that we just talked about. Shalom.